Two common questions that we get as it relates to picking the right company is mutual companies versus stock companies. And then we go a layer deeper in saying, should I be with a company that's direct recognition versus non-direct recognition? And in this video, my hope is to explain both so that you understand, so that you can be confident in making a decision about whole life insurance or just life insurance in general, whether you're working with us or somebody else. So let's talk about mutual versus stock. When you think of mutual, think of owned by the policyholders. You could think of it like a co-op. You could think of it like you're participating in the benefits or in the profitability of the company. So we as a company, if we're especially dealing with whole life insurance, only want to work with mutual companies. That's probably one of the hard and fast rules I can make. We want to work with mutual carriers because at the end of the day, we want to participate in the upside. We don't want there to be a conflict of interest between making the stockholders happy and the policyholders happy. And so when you look at just life insurance companies, I would say majority of life insurance companies are stock because you have people like Warren Buffett and other savvy investors that are saying, hey, insurance is the right move to be in. And that's why we want to look at companies that are still fully focused on making sure that the policyholder is getting the best benefit. The other thing you have to look at are there are mutual insurance companies that aren't necessarily great for whole life. They're essentially saying, we'll give you cheaper premiums, and that's like their benefit to the policyholder. We want to work with companies that will give us a policy benefit in the form of a dividend, ultimately enriching our policy with cash value and other living value benefits to our policy. And so we want to work with mutual carriers that are helping us, that are paying us in a dividend and are increasing the value of our policy. So that's the difference between mutual and stock. I don't know if there's any real benefits of a stock company. It might just be like if you're looking for car insurance or other things, there might be benefits in getting a cheaper premium. But overall, when we're dealing with whole life, you want to go with mutual. Now, the next question that we usually get is, should I get direct recognition or non-direct recognition? And this question is really how these companies deal with policy loans. And so we're a big fan of using your policy loan, especially if you can have an activity that is greater than the interest that you're paying. And it can be an amazing benefit, but a technical question is, what kind of company should I be with? And to break this down, a direct recognition company directly recognizes your loan. They essentially say, Caleb, you're taking a loan. We are going to affect your dividend, better or worse, because you're taking that loan. Versus a non-direct recognition company says, we're not going to directly recognize your loan. And so we're going to pay you the same dividend, whether you take a loan versus not. And there's a big debate as it relates to, what is better, what is worse. And this is what I would say. Obviously, working with somebody that can really get clear on what you want, design a policy, and then you should ask them, what happens if I take a loan? Let's compare this to another company that maybe will be non-direct and see the difference. What I will say is, if you're working with a mutual carrier that's good, that has your best interest, if you have a policy that's properly structured, the direct recognition versus non-direct recognition becomes less of an issue because you're working with a company that ultimately wants to make it best for the policyholders. And so in the short answer is it depends. And if you're going to do heavy loans early, non-direct recognition company might be where we want to lean. If you're not really going to be using loans early on, the direct recognition company might be better if the design's better. The other factor that we need to include is, it's very common, especially for people that fund a lot of cash into policies, is to get third-party lending. This is where you get like a bank or a third party to take your cash value as collateral and give you an even cheaper loan than the life insurance company would. And if you do that, it really doesn't matter whether you get direct recognition versus non-direct recognition. And you could make an argument that the direct recognition company would be better because it would give you a better loan and you would use third-party lending. And so maybe I just made the whole thing more complicated, but the moral of the story is, if you work with a mutual carrier and if you work with someone that can really understand the difference between different companies and customize a policy, in the end, you're going to be great and you're going to be so much better off than someone that might be with the best company, but a policy that's not properly designed.
I was given